Yes, today we are going to see standard costing. Standard costing. Now, what is standard costing? Before we go to see standard costing, we are going to make a recapitulation of what we studied earlier. Costing. What is costing? Costing means the cost of a project. The cost of a project consists of material, labor, and overheads. Now, there are three methods of costing, three techniques of costing. We have cost ascertainment, and we have decision making, and then we have cost control. So when we are three techniques of costing. When we are talking about costing, we mean these three components: cost ascertainment, decision making, and cost control. So this is the world of costing. So what we studied under cost ascertainment, process costing, we studied contract costing, we studied batch costing, we studied service sector costing. So these are what we mean when we say cost ascertainment. And decision making, we studied marginal costing, relevant costing, and cost control. So here we studied budgetary control, and standard costing that we are going to see today. Standard costing. So, cost ascertainment, and the cost ascertainment, we will study all these topics: cost ascertainment, cost control, and so on. So, we will study process costing, contract costing, batch costing, and service sector costing. And the decision making, we are going to study marginal costing, relevant costing, and so on. Cost control, and the cost control, we are going to study budgetary control and standard costing. So, now, and the cost ascertainment, this costing technique, we are going to calculate the cost of a product that has already been produced. So to produce good X, we have already produced good X, so we have to calculate the cost of good X. So this is done under this technique, cost ascertainment. Decision making. So here we have to calculate the cost of a product, that is the cost of a product that we will make in the future. This is decision making. So what will be the cost of producing good X in 2 months' time? So this will be discussed here under this technique, decision making. Cost control. Once the cost has been calculated, it has to be monitored with the future cost has been calculated. It has to be monitored with the actual cost in order to know whether the business is performing better or not, whether cost is increasing or decreasing. So we make comparison with future cost, what we call standard cost, and actual cost. So this is a world of costing, cost ascertainment, decision making, and cost control. So today we are going to see standard costing. Yes, budget, and standard. Budget and standard. Budget is a projection, standard also is a projection. But we have to know about budget, then we can understand standard. So let us see what we mean when we say budget. A budget is prepared according to historical cost information. A budget is prepared according to historical cost data with past information. Now, for example, management may ask the purchasing manager to buy materials at $15. This is a budget set by the company. Materials should be bought at $15. But the purchasing manager has bought materials at $25. So management, in this case, management will say that actual performance is not good. Actual performance is not good because material has been bought at $25. It should have been bought at $15. That is a budget prepared by the company. So this budgeted $15 was calculated according to historical cost information, that is past information in the previous year or 2 years back information. Materials could have been bought at $15, but today materials cannot be bought at $15. The market price is now $25. So in this case, management may ask the purchasing manager why he bought materials at $25 when the budget material cost is $15. So in this case, the purchasing manager may ask management that if you can buy materials at $15 now on the market according to the market price, then you buy it yourself. You can buy the materials. He may ask management to buy the materials. But in this case, we cannot make the purchasing manager responsible for the market price, that is $25. Material has been bought at $25 instead of $15, because this $15 has been calculated, has been based according to historical cost information. But today, the material price is $25. So in this case, we cannot make the purchasing manager responsible for this. So, but in budget, we cannot make anyone responsible for purchasing materials at higher prices. This is so. According to standard, a market research will be carried out. We'll try to carry out a market research before setting the material price. So in case the standard material price is 20, so the purchasing manager will have to buy the materials at 20, because most companies are buying the materials at $20. This is the market price. So all the market research has been carried out in order to obtain this market price. But if this time material is bought at $30. So in this case, we can question the purchasing manager, because this is a standard price. Most companies are buying at $20. So you bought materials, the purchasing manager buys materials at $30. So you can question the purchasing manager. So in this case, we can make the purchasing manager responsible for buying materials at higher prices. Purchasing manager can be made responsible. So the difference between budget and standard, both are projection. But in budget, we cannot make anyone responsible. But in standard costing, so we can make we can make the purchasing manager responsible because we have set a standard material price after investigation on the market. So materials should have been bought at $20, not $30. So in this case, we can investigate, we can make the purchasing manager responsible for purchasing materials at higher prices. So this is the difference between budget and standard. So budget can be prepared, budget can be suitable for small companies employing a small number of workers. So if we have only 5 employees in our organization, so every time we cannot make the employees to be responsible, the purchasing manager to be responsible for purchasing materials at higher prices. We have only 5 employees. Every time we cannot make them responsible for buying materials at higher prices. But standard, this one can be used in large companies, in large organizations where we have, let's say, 50 employees or more. So in this case, we have a purchasing manager in this department. We can make the purchasing manager responsible for buying materials at higher prices. So budget can be used in small companies, but it cannot be applied in large companies where there are a large number of employees and there is a purchasing manager. So in this case, for standard, we can make the purchasing manager to be responsible for buying materials at higher prices. Yes, budget can be compared with actual. Budget can be compared with actual, but we cannot make anyone responsible. Standard can be compared. We can compare actual with standard, can be compared, and at the same time we can assign responsibility to the production manager or purchasing manager and so on. So this is budget and standard. Now we are going to see reason in fall in profit. How do we calculate profit? Sales less costs, we will get profit. So if there is a fall in profit, so a fall in profit, either there is a fall in sales or an increase in costs. Either there is a fall in sales or an increase in costs or both. So costs, increase in costs. Costs, we have 3 elements in costs. We have materials, either the price of either material costs increase, labor costs increase, or overhead costs increase. So reason cost increase, either material cost has increased, or labor cost has increased, or overhead cost has increased. Today we are going to see materials. So increasing cost of materials. Now let us see a standard. Standard output. Let's say 1,000 units. 50 kilogram at $10. So we have to pay 500 actual output, same 1000 units. So here we are going to use 80 kilogram at 20. This will give us, say so. So standard material, we have to use 50 kilogram at $10 purchase price of materials per kilo. So we have to, this is the cost of materials that we are expected to buy at $500. Actual output same, 1000 units. So we use 80 kilogram instead of 50 kilogram in production, and we bought the materials at 20 instead of the standard price $10. So we spent 1,600 in purchasing materials. Material costs for actual output for 1,600. So we expect to pay materials at material cost $500, but we pay $1,600. We pay more, so there will be a decrease in profit of 1,100. Profit will reduce by 1,100. Now we have to assign responsibility. Who is responsible? How much of the fall in profit is responsible by the purchasing manager, or how much of the profit is responsible by the production manager? So we are going to see this one. So we expected to pay cost of materials $500, but we pay $1,600. We pay more than we expected to pay. So in this case, profit will decrease by 1,100. So we expect to buy, there are two reasons for the fall in profit. We expect to buy at $10, but we purchase materials at $20. This is one factor. Price of materials causing fall in profit. And the second factor, we expect to use 50 kilogram in production, but we use 80 kilogram in production. This is quantity. So these two are responsible for the fall in profit. Price will be under the responsibility of the purchasing manager, because he has bought materials at higher prices, and quantity, this one will be responsible by the production manager. Now we are going to see how much of the profit, the fall in profit, will be responsible by the purchasing manager, and how much of the profit, fall in profit, will be responsible by the production manager. So we have to use responsibility accounting. Now, so difference in price will be responsible by the purchasing manager, and difference in quantity will be responsible by the production manager. Now, let's see. Difference in price. Okay? Difference in price. So, difference in price, $10, but the manager pays $20. Difference in price, $10. Now, so the difference in price is $10. So profit will be reduced by only $10 by the purchasing manager out of 1,100. No, we have to multiply this by quantity. Now we have two quantity. We have standard quantity and we have actual quantity. Which quantity will be used to multiply the difference in price? Either the standard quantity or the actual quantity. Now, if we ask the purchasing manager what quantity we have to use in order to make him responsible for the difference in price, the purchasing manager. One time we become the purchasing manager, another time we become the production manager, and then we see which one we have to use. Now, if we ask the purchasing manager which quantity to be used here, the purchasing manager will say, which quantity the purchasing manager will say? 50 kilogram or 80 kilogram? The purchasing manager will say 50 kilogram. Okay? The purchasing manager will say 50 kilogram. So he will say standard. Standard kilogram, this will be the answer of the purchasing manager. And now, if we ask the production manager which quantity to use, 50 kilogram or 80 kilogram, the production manager will say 80 kilogram. The production manager. Now, let's say which one is good. The purchasing manager is saying to use 50 kilogram of materials, but the purchasing manager has purchased quantity of materials. The purchasing manager has been given a standard of 50 kilogram. So he has to purchase at 50 kilogram. He has to purchase 50 kilogram, but he purchased how much? 80 kilogram. So it is wrong to say to use 50 kilogram because he has purchased more than he was required to purchase. He was required to purchase 50 kilogram, not 80 kilogram. Now the production manager, he has to use 50 kilogram, but he used 80 kilogram. So this is a production manager. So for the production manager, it is 80 kilogram. Which one we have to use? We have, so how much of the difference in price will be responsible by the purchasing manager? $10 times which quantity? 50 kilogram or 80 kilogram? Because the purchasing manager should buy at $20 at 50 kilogram, but he bought 80 kilogram. So we have to multiply by 80 kilogram. So out of 1,100 profit, $800 will be responsible by the purchasing manager. The purchasing manager will be responsible for a fall in profit by $800. So we have to multiply by actual quantity. So this is for the purchasing manager, the responsibility for the purchasing manager out of the fall in profit of 1,100. So he is responsible for $800 profit, fall in $800. We expect to pay $10, but we pay $20. We pay more for materials. So profit has decreased by $800 by the purchasing manager. Now let's say for the difference in quantity will be responsible by the production manager. Difference in quantity will be responsible by the production manager. Difference in quantity. So difference in quantity, 50 kilogram times 80 kilogram minus 80 kilogram. So this will be responsible. That should have used how much? 80 kilogram. Should have used 50 kilogram, but he used 80 kilogram more material has been used in production by how much? 30 kilogram. And now we have to multiply it by the standard price. The standard price, what is the standard price? $10. So we multiply by $10. This will give us $300. So this is the production manager. The production manager is responsible for the fall in profit by production manager is responsible for the fall in profit is responsible for fall in profit by $300. So $380 800, this will give us 1,100. So here we have assigned the responsibility of the production manager and the purchasing manager. So this is, and the standard costing, we can assign responsibility to the purchasing manager and to the production manager. At times, the purchasing manager may be driven out from employment, or his wages may be kept because of negligence of reducing the company's profit. So he may be given penalty as in terms of salary cut, or he may be driven out from the business. So here we are, so far concerning standard costing. Now we are going to see the last part of material variance. Now we have to calculate material cost variance, material price variance, material usage variance, and tests. Now let us see how do we calculate material cost variance. Material cost variance. Material cost variance. So we are going to see the difference in terms of costs. So the standard cost minus actual cost. So what is the standard cost? $500 minus actual cost $1,600. So the difference will give us, we expect to pay the cost of materials to be 500, but we pay 1,600, so we pay more. So this will be adverse. Profit will be reduced by 1,100. This is material cost variance. And now, second, material price variance. So, why profit has decreased? Two factors. Material price variance. So, we are going to see the difference in terms of price, the standard price minus actual price times actual quantity. So, we have to replace the standard price, $10 minus actual price, $20 times actual quantity. What is actual quantity? 80 kilograms. So in this case, we will get $800. We expect to pay material at $10, but we pay 20, we pay more. So this will become adverse. $800 adverse material price variance. And now we are going to see material usage variance. Usage means quantity. So material usage variance is standard quantity minus actual quantity times standard price. So we have to replace the standard quantity 50 kilogram minus 80 kilogram times standard price $10. So this will give us $300 adverse. We expect to use 50 kilogram in production, but we use 80 kilogram. We use more materials in terms of kilogram in production. So this will become adverse, 300 adverse. And now we are going to test to see whether the answer is good. Testing. So test is equal to cost is equal to price plus usage. So let us see this one. Cost is equal to price plus usage. So what is the formula for cost? Standard cost minus actual cost. So this is the formula. Is equal to price. Price, what is the formula? Standard price minus actual price times actual quantity. And plus, what is the formula? Standard quantity minus actual quantity times standard price. So this is the formula. Standard quantity, standard cost minus actual cost is standard price. So we can, this one we can remove the brackets. So standard price times actual quantity minus actual price time actual quantity plus standard quantity time standard price and actual quantity time standard price. So let's see this one. Standard quantity, standard price times standard quantity. Standard quantity times standard price. This one will be eliminated. Minus this one will be eliminated. So we will have actual price times actual quantity. This will be actual cost. Actual quantity times standard price. This will give us standard cost. So here we are just to check whether this formula is good. Now we replace just to check material price. How much we obtain material price with some advice plus usage was advice. So this will give us 1100 advice. So here we are concerning the first part of material variances. Thank you very much for your attention.